Picture this for a moment. You go to sleep with silver sitting where it has hovered for years, ignored by mainstream media, dismissed as boring, and when you wake up, history has been made overnight as silver smashes through the psychological ceiling of $100 an ounce, shocking investors, forcing analysts to rewrite models, and sending a silent but powerful signal that the entire precious metals market has just entered a new phase, one that also demands you watch gold more closely than ever before. Silver hitting $100 would not be a random spike or a meme-fueled anomaly. It would be the result of pressures that have been building quietly for decades. Pressures most people never bother to connect because silver has always lived in the shadow of gold. To understand why this level matters, we need to strip silver down to its true identity. Silver is both money and material. It is a store of value with thousands of years of monetary history, and at the same time it is an industrial workhorse consumed by modern civilization. Unlike gold, which is mostly hoarded and stored, silver is used up. Once it goes into electronics, solar panels, medical instruments, and advanced technology, much of it is gone for good. This creates a unique dynamic where rising demand does not simply sit in vaults but actually drains above-ground supply. Historically, silver has always lagged gold at the start of major precious metals bull markets, and then violently caught up later. This is not opinion, it is pattern. In the 1970s, gold began moving first as inflation surged and trust in paper currencies eroded. Silver followed later but moved much faster, ultimately outperforming gold by a wide margin in percentage terms. The same pattern repeated in the early 2000s after years of monetary easing and debt expansion. Silver is like a coiled spring. It appears calm for long stretches, then releases energy suddenly and explosively when conditions align. The idea of silver reaching $100 forces people to confront ratios they usually ignore. One of the most important is the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 15 to 1 during periods when both metals functioned as money. In modern times, it has stretched to extremes, sometimes exceeding 80 or even 100 to 1. If gold were sitting at $2,500 and the ratio merely returned to a more conservative 25 to 1, silver would already be at $100. That alone shows how mathematically plausible this scenario is without requiring anything extreme. Now layer in the supply side. Global silver production has struggled to grow meaningfully despite rising demand. Much of the world's silver is produced as a byproduct of mining other metals, meaning miners cannot simply turn on the tap when silver prices rise unless copper, lead, or zinc economics also justify expansion. At the same time, ore grades are declining. It takes more rock, more energy, and more capital to produce the same ounce of silver today than it did decades ago. This raises the true cost of production, quietly putting a floor under prices that many paper traders fail to respect. Demand, on the other hand, is not slowing. Solar energy alone consumes a massive and growing amount of silver due to its unmatched electrical conductivity. Electric vehicles, charging infrastructure, 5G networks, medical technologies, and consumer electronics all depend on silver in ways that cannot be easily substituted. Even if thrift and efficiency reduce silver content per device, total demand continues to rise because overall production volumes explode. This creates a structural deficit where annual demand consistently brushes up against or exceeds new supply. Investment demand adds another powerful layer. When confidence in currencies weakens, people instinctively look for assets that cannot be printed. Gold usually gets the headlines, but silver attracts a different crowd. It is more affordable per ounce, more volatile, and historically delivers sharper moves once momentum builds. In times of monetary stress, silver becomes the metal of the people. A move to $100 would likely reflect not just industrial demand, but a global psychological shift toward tangible assets. Critics often argue that paper markets prevent such moves by providing liquidity and price discovery. Futures contracts, options, and unallocated accounts trade enormous volumes of silver every day. But these instruments rely on trust that settlement can occur without widespread physical delivery. When too many participants decide they want the metal instead of cash, the system tightens rapidly. Premiums rise, delays appear, and the disconnect between paper prices and physical reality becomes impossible to ignore. If silver were to break and hold $100, the implications for gold would be profound. Historically, silver does not lead in isolation. It confirms and amplifies trends already underway in gold. A silver breakout of that magnitude would suggest that gold is either undervalued or preparing for its own explosive leg higher. Gold tends to move in larger, steadier waves, while silver spikes in bursts. Watching silver hit triple digits would be like seeing smoke before the fire fully reveals itself in gold. Psychology plays a critical role here. Round numbers matter because humans assign meaning to them. $100 is not just a price, it is a statement. It forces media attention. It triggers institutional reviews. It challenges long-held assumptions that silver is a stagnant or secondary asset. Once those mental barriers break, new participants enter the market, often late but with size, pushing prices even further. This does not mean the path would be smooth. Silver has always been volatile. Sharp pullbacks, aggressive corrections, and emotional swings are part of its nature. But volatility cuts both ways. It is precisely what allows silver to compress years of price movement into months or even weeks once momentum takes over. A move to $100 would not be a straight line, but it would reflect forces far larger than speculation alone. At its core, this scenario is about trust. Trust in currencies, trust in financial promises, trust in systems that rely heavily on leverage and assumptions. Silver thrives when that trust erodes, even slightly. It does not need total collapse to reprice dramatically. It only needs enough people, institutions, and industries to realize that physical supply matters more than paper representations. And once that realization spreads, it spreads fast because